A little bit of upbeat music for a man who's in top form. Although recently, Piet, these markets have been bumping all over the place. I was having a look at the holdings in the Counterpoint Value Fund and then having a look back at where they were in March, some of them, and where they are today. And there has been quite a change. So we're going to be talking about that. Piet Viljoen is the portfolio manager of the Counterpoint Value Fund. I'm Alec Hogg from BizNews.com. And Piet is also a keynote speaker at the BizNews Conference at the end of August, early September. I'm looking forward to that, Piet, and I know your hordes of fans who have already booked. What are you going to be telling them?
I think we're going to be speaking about just what's going on in the market, maybe some new ideas that have popped up, and more importantly, the process of managing money, because I think that's probably the thing. You can always talk about this stock and that stock, but nobody ever gets stocks right 100% of the time, especially not in the short term. But I think where one can add a lot of value, and I think where, it is talking about how to think about managing money, how to think about the process of managing money, because I think the process is an important thing. When rugby teams practice, they don't practice scoring tries. You can see them doing drills on the field, doing the same drill over and over and over. And it's not a drill of scoring a try, it's a drill of creating space, passing the ball into space, running into space, tackling. And they do those drills over and over, and that leads to tries, that leads to success. And I think it's the same with money management. If you have a process which is sensible and which works over the long term, and you apply that process consistently, you will score the tries at the end of the day.
So you're going to help our community, our tribe, to get their process.
That's the key message.
I'm just having a look at the value fund. It is the top performer in South Africa on all unit trusts. It's about 750 million rand now. Are you getting to the point where Charlie Munger talks about size being
Not yet,
an anchor?
no. I think this fund can still grow substantially, but I reckon when we get to about 1.5 to 2 billion, that's when we start putting on the brakes. Yeah.
And you've done that before. I recall you actually capping your fund in the past.
We did. We capped our funds at RCM in 2006, I think it was, around about there. A combination of two things. They were getting too big, and also the market was getting quite expensive. Of course, at that time, it was not a popular move because about a year and a half later, with the global financial crisis, it turned out to be the correct move.
And you wouldn't look at doing that anytime soon, certainly
not with the current fund, but there will come a time, if the flows continue and the performance continues, that we will have to start thinking about doing that, because size is the enemy of performance. There's, you can just look at what's going on in the general equity category in South Africa. The top performing funds are the smaller funds. The big funds all underperform the benchmark consistently.
But most asset managers don't worry about that because they make more money.
Of course, yeah. So that you have that perverse incentive, or where the agent makes a lot of money and the principal, the investor, doesn't. So you've got that principal agent conflict in the asset management industry. The asset management industry is rife with that conflict, and it's not always managed very well.
How do we, as members of the public, identify those kind of conflicts?
They're right there in front of your eyes. When asset managers brag about the assets under management, that's the conflict right there. But the thing is, people are herd animals. They feel safe in big herds. That's why when you invest with a big fund manager, you feel safe because everybody else is investing with a big fund manager. But investing, your animal instincts are the enemy of good performance. Your flight instinct when stock prices go down, I guess we'll talk about that in a minute. When stock prices go down, your first instinct is to flee. You flee from fear. You flee from danger. That's your animal instinct kicking in. And that's not always the right thing to do in investing. And herding is another animal instinct we have as human beings. And that's also not a great thing to do in investing.
Before we go into that side of it, just one last point on the value fund, on your fund, because we don't talk about it very often, Peter. You share your wisdom with us, but we don't talk about your own business. But I was interested to see that your risk profile in your fact sheet says high. Now, you talk about a 7-year time horizon. why would the risk profile be high if you're telling people, look, put your money here for 7 years? If you take it out before 7 years, then I could understand that the risk might be high. But surely 7 years, that risk would.
So, of course, now risk is different things to different people, but according to the regulators and the way things are measured and standardized, risk is equated with volatility, or volatility is equated with risk. And investing in equities is a volatile endeavor. It doesn't matter what type of equities, whether you're investing in value equities or growth equities or index or anything. In the short term, there is volatility associated with investing in equities, and therefore it is classified. Any equity fund is always classified as a high risk fund.
All right. So it's not necessarily
No,
just your fund.
Yeah. Yeah. Again, these things are arbitrary. I think that's been standardized for the industry at 7 years. I mean, that's just. I think the industry has agreed on that number, and I think it's if you look at unit trust statistics, and it's actually across the industry. If you look at home ownership statistics as well, people stay invested in unit trust and own a house for on average around 7 years. It's just it's fascinating, but that number pops up in a lot of ownership statistics. That's roughly. A cycle is probably 7 to 10 years, a full up and down, 7 to 10 years. Yeah.
All right. So that gives us a good background for what's happened in the last few months. Since March, resources shares, of which you have quite a few in your portfolio, certainly in your top 10, Sibanye, Exxaro, Anglo, Goldfields, they have come down pretty sharply in that period. Is this just part of the knock that one would expect, or the volatility, or is it something maybe that would change your mind about what you should be owning?
If one expected this sort of knock, you probably wouldn't have owned them 3 months ago. You probably would have sold them. So I can't say I expected this sort of knock, but yes, one expects this sort of volatility from time to time. You just don't know when it's going to happen. That's the thing. But it does happen from time to time. Share prices go up a lot sometimes, like they did last year, and up until March, they went up a lot. Nobody calls it volatility, but it's also volatility. And now they've gone down a lot, and now it's volatile to the downside. I would point out one thing, that net year to date for the first 6 months of the year, despite the downdraft in some of the resources shares over the past 3 months, the fund itself is still up 1.5% for the year to date, which I think relative to any index and most other funds out there is still a good performance. So yes, there has been some downside, but before that there was a lot of upside. So the downside is not as bad. But I think one should focus on, does this downdraft represent a permanent loss of capital, or is it a temporary loss of capital? I think that's the key aspect one needs to think about. So if one thinks about that, when do you face a permanent loss of capital? And I guess there are three things that you need to think about in terms of that. The first thing is it an outright fraud? Are you invested in outright fraud? Because then you can face a permanent loss of capital, something like Steinhoff or Tongaat or that sort of thing. That's a permanent loss of capital. You're not making that money back. That's gone. Is it a growth bomb? In other words, a company with very high embedded growth expectations where the underlying reality does not match that. So the share price reflects the expectations and the underlying reality doesn't reflect it. And then you can lose a lot of money on a permanent basis. You're not making it back. Something like Naspers would be an example of that up until about 9 months ago. Possibly Netflix as well. A lot of the FANG stocks were just they had very high embedded expectations of them. Good businesses, but they couldn't match those expectations fundamentally. So that represents a permanent loss of capital as well. And I think yes.
Just unpack Naspers quickly.
Well, at one point, Naspers was trading with very, very high embedded expectations as to the future. And although I think for parts of that business, the future is bright, it's never going to reach those sort of lofty heights that the market was expecting, say, 18 months ago. It's highly unlikely. Plus, there have been some capital allocation mistakes in the meantime as well. But those are just like examples, and there's many, many of those sort of examples. Growth stocks which are priced too richly, that can represent a permanent loss of capital. And the third one is these value traps, where you buy a cheap stock, but it just stays cheap forever. And it possibly goes down as well because, it doesn't create shareholder value. So those are the three types of stocks that could cause you to lose money on a permanent basis. And I think when one looks at your portfolio, you should look at and see if you own any of those. And the clue as to whether you own any of those sort of stocks is cash flows and balance sheets. Does the business generate strong cash flows? And or does it have a solid balance sheet? If you can tick those two boxes, then a decline in the share price in the short term represents a buying opportunity. It doesn't represent a permanent loss of capital. But when there is a lack of cash flow or very stretched balance sheet, then it could represent a permanent loss of capital. The whole thing with Steinhoff was always that there was never any cash flow. There was always a question mark around Steinhoff. There was never any cash flow. And resource shares in 2014, 2015 had very stretched balance sheets. So when the commodity prices came down, they made losses, big losses, and had to issue equity, dilute their shareholders. That represented a permanent loss of capital at that time. Today, if you look at the top 10 shares and say the Counterpoint Value Fund, there's one common denominator. All those companies have very solid balance sheets and are generating very strong cash flows. So, yeah.
It's an interesting point on this one, Piet, because similarly with banks. And I
That's
see
correct,
you've got three
Yeah.
financial services companies in your top 10. They seem to be far better resourced or have much stronger reserves today than going into the last recession
Exactly.
or the last global
The bank's
economic
capital
slowdown.
asset ratio are running 12, 13, 14%. Lots of the banks are sitting with excess capital. And I think it's not inconceivable that one can even expect some special dividends in the future coming from some of these financial services companies, including the banks. So solid balance sheets, generating a good business, possibly not growing as much as they could, but that's a free option to the upside. If they start growing, then I think you could see some good price action. Who knows whether that will happen or not. But the fact that the share price has come down does not represent, in my books, a permanent loss of capital because the business is sound. And if you go through all the resource shares, they're trading on multiples of 3, 4, highly, unleveraged balance sheets, cash on the balance sheet, generating cash flow yields of 20 to 30%. So that'll come down as commodity prices come down. Those cash flow yields will come down, but they're still generating positive cash flows. Sasol oil companies are discounting oil prices of $65. So the oil price comes down from 120 to 100, and the Sasol share price comes down. It's still making tons of money. And the same goes for gold companies, platinum companies. Coal companies are still printing money. Coal price is still high. So to my mind, what's happened now has been possibly that sector, the resource sector, has attracted a lot of speculative money because of the good performance through to March. And a lot of that speculative money is being washed out of the market now. And I think that provides a buying opportunity, not a selling opportunity. It's not a permanent loss of capital what's happened. It is a temporary loss of capital based on the fundamentals.
All of those stocks that you've got, the resources stocks in your portfolio, would you now be adding to them, given your what you've just explained now, and your very famous, if hamburgers are available at half price, you buy
Yes,
two?
that's correct. Yeah, 100%.
So you'd be buying more
Yes.
of Exxaro, Sibanye, Anglo, Goldfields. Goldfields are an interesting one because there is a
The Yamana transaction, yeah. So they made an offer to purchase Yamana. Look, the share price had run up a lot, so I guess they wanted to take advantage of that. Plus, their life of mine was contracting somewhat, which is never a great place for the management of a resource business, because management's interest is to extend the life of mine so that they can have a job in 10 years' time. And sometimes it might make sense to run the mine down profitably and just extract as much cash as possible. So that's another debate for another day. But they've announced this transaction, a mooted transaction with Yamana. And fundamentally, it makes sense. It extends the life of mine. It's got good assets in good areas. It's probably overpaying a bit. So net, I would say that at the higher share price, it wasn't great, but at the current share price of Gold Fields, it's probably net neutral.
You mentioned Sasol. I had a fascinating chat with an old friend of yours who you're going to see at the conference
Yes.
coming up, Sean Pesh. He's coming out from the UK. He's going to come and talk to us about his view on the global market. He's very excited about Total. Is this one that's come across your radar screen, given that Sasol is one
Look,
of
I'm
your
very
big
excited about
shareholders?
the whole oil energy environment, whether it's Sasol or Total or whichever oil company. I don't think it matters that much. What's happening in the energy space is that because of, and I'm sure Sean has spoken about this as well, there's lots of factors that contribute, but one of the main factors is this whole ESG movement where, you don't want to drill for oil, you don't want to disturb the environment because we're all going to have, access to clean energy via photovoltaic and wind power. It's going to be easy transition, it's going to be easy and simple, and energy is going to be free, and we don't have to pollute the air anymore with carbon-based fuels. So in theory, that sounds great. In practice, it's not that easy. It's going to cost a lot of money, and it will take a lot of time to get there. And in the meantime, if you're not expanding or at least maintaining your access to energy, and you become dependent on places, countries, leaders who are possibly not of the same inclination as you, then you'll become beholden to them. And that's exactly what's happened in Europe. Energy prices there have gone through the roof. It's impacting the economy there. And this might serve as a wake-up call in the world to say that, hang on, yes, we understand there's always a trade-off, but we do need energy to be warm and to be able to eat. Energy is life at the end of the day. So, would you rather save a human life or a fish in the ocean? And that's the sort of trade-off we need to talk about in a very simple term.
Can we just close off with those financial services shares? FirstRand, Absa, Sanlam. I'm sure that you saw the quarterly results coming out in Wall Street, where for the most part, the profits are down. But for some of the companies, these have already been written into the numbers.
Yeah.
And as a result, when the financials were released, the shares went up. Those three stocks, FirstRand, Absa, we do have in the BizNews portfolio. Sanlam is also quite an interesting business in the way that they're expanding around the world, and there must be something real appealing for them to be in your top 10.
So all three of them, let me say. So I think both FirstRand and Sanlam have strong internal cultures which lead to value creation over time. And they're both available today at prices which don't expect continued value creation forever. So I think that's quite a strong combination. And in the case of Absa, you have a business where I think the culture is busy changing. It was poorly managed for a long time, but I think it's busy changing. It's improving, and the share price is expecting continued decline and continued poor management. Again, that's a good combination to get hold of. So slightly different for FirstRand and Sanlam versus Absa, but in all three cases, I think that the share prices are discounting continued bad things and are disregarding the good fundamentals that all three businesses have.
Piet, before you go, when we spoke last of the challenge with Magnus, the R1 million challenge, offshore versus local, you were
so easy.
creaming him. Now it looked easy. When I spoke to him last, he said, no, it's like a horse that was 20 lengths behind. It's come to 2 lengths now. What should we be looking for there for the next report?
I'm not tracking on a short-term basis. I would guess I've given up a lot of ground. I don't know if I've given up all the ground yet, but I suppose I've given up a lot of ground. Look, I continue to think that the South African market, we've spoken about a whole bunch of shares here today that are extremely cheap. So my view is the same. Despite the short-term volatility, or the short-term volatility is actually a good opportunity because the fundamentals are still intact. Strong cash flows, strong balance sheets. If you look at commodities generally, we spoke about oil just now. The world in 5 to 10 years' time will most likely be undersupplied of a broad range of commodities because of the dynamics happening, especially in the Western world, in terms of ESG and carbon and all those sort of things. And the world needs those things. The world grows every year. Global GDP grows by 2 to 3%. The demand for commodities grows over time steadily. There might be a year where it declines a little bit, but it picks up again. And the demand line for commodities is a diagonal line going up over time. And the supply is a volatile one. And at the moment, there is no sign of increased supply of many, many commodities. And at some point, that is going to catch up. And the incentive to increase supply is higher prices. And you can already see that happening in Europe with the energy prices. They are looking around, seeing where they can get the energy from. And the same will happen with many, many other commodities. Price is a signal which incentivizes higher supply. And prices are not high enough by any stretch of the imagination yet. It appears to incentivize increased supply.
The cure for a high oil
exactly,
price.
Yeah. And apparently it's not high enough yet.
Etc. So, Piet Viljoen, the director of Counterpoint and the manager of the Counterpoint Value Fund, and I'm Alec Hogg from BizNews.com.